The hypersonic phase just started. Not in a war zone, not in the skies, but inside the global market itself. And this time the warning didn't come from headlines or breaking news. It came from something far more subtle, far more dangerous. The world's financial system is beginning to fracture under its own weight, quietly, systematically, and almost nobody is paying attention. Because from the outside everything still looks normal. Stock markets are open, banks are operating, governments are calm. But beneath that surface, something massive is shifting. Liquidity is tightening, volatility is rising, correlations are breaking. These are not random signals, these are early warning signs, the kind that appear right before a system enters a crash phase. Here's the reality. A single shift in liquidity can now destabilize trillion-dollar markets. A minor disruption in funding can ripple across continents. That's the vulnerability. A system so large, so interconnected, that even small shocks can trigger massive consequences. And that's exactly what we're seeing right now. Global markets are flashing signals that haven't aligned like this since major historical collapses. Bond yields are rising aggressively, equity markets are showing signs of stress, commodities are becoming volatile, and currency markets are entering unstable territory. This is not noise, this is escalation. Let's break it down. The global economy runs on liquidity, not just money, but access to money, credit, funding, confidence. And right now, all three are tightening simultaneously. Interest rates have surged at one of the fastest paces in modern history. Central banks trying to fight inflation have pulled liquidity out of the system. But that liquidity wasn't just supporting growth, it was holding the entire structure together. Remove it, and the cracks begin to show. Now look at the bond market, the foundation of global finance. Trillions of dollars in government debt, once considered the safest investment in the world. But now, yields are rising, prices are falling, and volatility is increasing. This is critical, because when bonds become unstable, everything else follows. Mortgages, corporate debt, government financing. This is the backbone of the system, and it's under pressure. Now move to equities. Stock markets have been driven by cheap money for over a decade. Low interest rates, easy credit, massive liquidity injections. But that environment is changing. Companies that relied on cheap borrowing are now facing higher costs. Valuations built on low rates are being questioned, and investors are becoming cautious. This is how bubbles deflate, not instantly, but gradually, then suddenly. Now add currencies into the equation. The US dollar is strengthening in some areas, but under pressure in others. Emerging market currencies are volatile. Capital is moving rapidly across borders, searching for safety, searching for yield. This creates instability. Because when currencies move unpredictably, trade becomes uncertain, investments become risky, and confidence starts to erode. Now here's where it all connects. Liquidity, bonds, equities, currencies, all showing signs of stress. At the same time, this is not coincidence, this is systemic pressure, and systems under pressure don't stay stable for long. Now here's the contrast that most people miss. On the surface, the system appears strong. Governments project control. Central banks communicate confidence. Markets continue to function. But underneath, the vulnerabilities are growing. Debt levels are at historic highs, over $300 trillion globally. That's more than 3 times the size of the global economy. Think about that. A system built on leverage, on borrowing, on the assumption that growth will continue. But what happens when growth slows and borrowing becomes expensive? The entire structure becomes unstable. This is the hidden risk, because the system doesn't fail when things are weak. It fails when they appear strong but are structurally fragile. Now to understand where this leads, you have to look at history, because this pattern has played out before. Look at 1929. The global economy was booming. Stock markets were rising. Confidence was high, but underneath, leverage had reached dangerous levels. Credit was overextended, and when liquidity tightened, the system collapsed. Look at 2008. Housing markets were strong, financial institutions were powerful. But beneath that strength was a web of risky debt. And when that debt began to unravel, the entire system was pulled down with it. Now look at today. Different assets, different players, but the same pattern. Excessive debt, tightening liquidity, rising instability. This is not new. This is history repeating itself. But with one critical difference: scale. The current system is larger than anything we've seen before, more interconnected, more complex, which means the consequences are also larger. Now let's go deeper into the financial forces driving this. Debt is the core. Governments have borrowed massively to sustain growth. Corporations have leveraged balance sheets to expand. Consumers have relied on credit to maintain lifestyles. This created growth, but it also created dependency. A dependency on low interest rates, on easy money. But now that environment is gone. Rates are higher, liquidity is tighter, and the cost of sustaining that debt is increasing rapidly. This is the pressure point, because when debt becomes too expensive to manage, defaults begin. Not all at once, but gradually. And each default weakens the system further. Now add inflation into the mix. Inflation erodes purchasing power. It forces central banks to act, to raise rates, to tighten conditions. But those actions create more stress. This is the trap. Fight inflation and risk a crash. Support growth and risk currency collapse. There is no easy solution. Now consider the geopolitical layer. Trade tensions, resource competition, energy shifts. These are not separate issues. They are financial issues. Because control over resources is control over money. And in times of financial stress, competition intensifies. Nations protect their interests. Alliances shift. Systems fragment. This adds another layer of instability. Now combine everything. Debt pressure, inflation, tightening liquidity, geopolitical tension, and you get a system under extreme strain. This is not a normal cycle. This is a breaking point. Now let's look forward. In the next 24 to 72 hours, markets may react sharply to new data, interest rate expectations, economic indicators, policy decisions. Volatility will increase, sudden moves, unexpected shifts, because when systems are fragile, small triggers can have massive effects. In the longer term, the implications are even more serious. If current trends continue, we could see a broad market correction, not just in equities but across multiple asset classes. A synchronized decline. This is rare, but when it happens, it's powerful. Because diversification no longer protects, everything moves together. And that's when panic sets in. That's when liquidity disappears. That's when markets crash. Now here's the most important point. Crashes don't happen because of one event. They happen because the system reaches a point where it can no longer sustain itself. And right now, we are approaching that point. The signs are there. The signals are clear, but the system hasn't broken yet. That's what makes this phase so dangerous. Because it creates a false sense of security, a belief that everything is under control, until suddenly it isn't. And when that moment comes, it moves fast. Faster than most people expect. Faster than most systems can handle. This is the nature of financial collapse. Gradual then sudden. So here's the final warning. We are not just witnessing market volatility. We are witnessing the early stages of a potential systemic event, the kind that reshapes economies, resets financial systems, and redistributes power. History shows us how this ends. Empires built on financial strength fall when that strength weakens. Not overnight, but inevitably. The only question is, are we at the edge of that collapse, or already falling into it?